You might have to see it to believe it, so here it is. Boring old European financials have actually beaten the Magnificent Seven over the past 3 years. And the best part? I think they could do it again in the next 3 years. In this video, I'll dive into how they did it, why I think they can do it again, and at the very least, why I think they could be an excellent complement to a position in something like the Mag 7, NASDAQ, S&P, Momentum, or other US growth-oriented investments. Let's dive in. One of the main reasons that US stocks have done so much better than non US stocks since 2008 is that US stocks are heavily weighted toward tech and European stocks are heavily weighted toward financials. And what's happened? Well, tech has been boosted by the growth of faster internet, the rise of the smartphone, and then more recently, AI. When you think about all the industries that those things power, like cloud computing, social media, streaming services, and so forth and so on, they're pretty much all dominated by US companies. The top 10 companies in the world right now are all internet related companies, if you count Tesla, and 9 out of 10 of them are based in the US. That should concern you, but more on that later. The main point is that everything has been going well for tech for a long time, and most of the tech is in the US. On the other side, European financials have had everything working against them. The green line is the German 10-year bond yields, and the blue line is the 10-year treasury yields here in the US. They were low everywhere, and it's not like US banks have done great either, but US banks are way smaller in the US indexes, and European banks have had a way tougher environment. Think about the main way banks make money. They borrow money at very short-term interest rates, usually close to zero on the money that they pay you for the deposits in your checking or savings account. And then they lend it out at a higher long-term interest rate for things like car loans, mortgages, or business loans. Well, with 10-year rates near zero or even negative at times, how are they supposed to make money? There was also slower growth in Europe since European governments were a lot more fiscally responsible, while successive US governments spent like drunken sailors. And oh yeah, there were massively rising regulatory costs for banks because, well, we'd just come off of the financial crisis. Then came rising rates in 2022. And not only did it make it harder for early stage tech stocks to get cheap funding, it made it way easier for banks to make money. And that flipped the script. That's why European financials have done better than the Mag 7 over the past 3 years, even though the Mag 7 have had a significant rally due to AI optimism. And that brings us to where we are today. Could boring European financials really do better than the Mag 7 and the high-flying tech sector again over the next 3 years? Yes, I think they could. And at the very least, I think they make a really nice complement to a US tech-heavy portfolio. Let's start with why I'm cautious on how much longer the Mag 7's run can last. This is a list of the top 10 largest companies in the world at the end of each decade. What's the one thing you notice here? I'll give you a hint. In 1980, more than half of the companies were oil companies. In 1990, 8 out of 10 were Japanese companies. But we know that turned out to be a bubble because 10 years later, in 2000, only 2 of them were Japanese companies. And at that time, it was all about the internet. Almost every single company was internet related. But that also turned out to be a bubble. 10 years later, only 1 of those internet related companies was left in the top 10. And the hot thing had shifted to emerging markets and commodities. 9 out of 10 companies were either outside the US, an oil company, or both. But if that had been the focus of your investments in 2010, the next decade would have been pretty rough because by 2020, it was all about the internet again. So, what's the one thing you should notice here? The makeup of the top 10 companies rarely looks the same 10 years later as it does today. So, that brings us back to the point I made earlier that I promised I would expand on. Why should you worry about the Mag 7 and anything else US growth focused? Because 9 of the top 10 companies right now are US companies, and either 9 or 10 of them are internet related, depending on how you count Tesla. I count it because I think Teslas are basically computers on wheels, but I digress. This doesn't mean all these stocks are about to crash any minute now, but no matter how positive you are on AI, remember, if you thought the internet was going to change the world in 1999, you would have been right. And also, you would have had a terrible decade of investment results after that. So we have seen this story before. I, for one, do think AI is in a bubble, but that's a topic for another video. Leave a comment below if you'd like us to do a deeper dive on why. But either way, even if you disagree with me and you don't think AI is in a bubble, we can probably at least agree that no one knows for sure if it's a bubble or not, and overly concentrating your portfolio in whatever has been the hottest over the past decade has rarely ever worked out. So it's definitely a huge risk, even if you're right about AI changing the world in the long run. On the flip side, I do think that European financials still have some room to run. But before I get to why, one thing that's almost as hard to believe as European financials beating the Mag 7 is that 73% of you who watch this channel regularly still haven't yet subscribed to it. So before we continue, can I ask you for a quick favor? If you like this channel and you're getting value out of it and you want to support us, the free and easy way to do that, it would have a massive impact on our lives and cost you nothing, is by simply hitting the subscribe button. And my commitment to you is that if you do that, my partner Cal and I will do everything in our power to help you significantly improve your life by becoming a better investor. Thank you so much. For anyone who's been watching this channel for a while, you probably know I'm not really one to chase results. I'm not interested in European financials because they've done well for the last 3 years. I'm interested in them in spite of the fact that they've done so well for the last 3 years. There are three reasons why. First, while European financials have seen their valuations rise from their lows, they're still cheaper than they were at a lot of points in the last 10 years, when they had a way harder time making money. That makes no sense to me. And on the other hand, US stocks, represented by VU, the Vanguard S&P 500 ETF in blue, are more than 2 times as expensive and are near their peak from the last decade. Actually, they're almost as high as they were at their peak in the tech bubble. So, while European financials are up a lot, they're definitely not experiencing the same kind of exuberance that US tech stocks are. Mainly, their stock prices have been driven by good old fundamentals. They're just managed way better than they used to be, and they're operating in a way better environment now than they were before, and their profits have increased accordingly. Reason number two that I'm optimistic on European financials is that while the environment has improved for them a lot, it's likely to get even better. Two main things matter for financials: interest rates and economic growth. And starting next year, there is going to be a significant uptick in fiscal, aka government spending, to support European economies. Remember, for most of the last 15 years, the US has spent like drunken sailors, and Europe, well, hasn't. But now Europe is finally doing more. And what does more borrowing for fiscal stimulus mean? Higher interest rates and higher economic growth, the two things that really matter for financials. Insurance companies benefit from higher rates because they invest a lot in long-term debt. Financial exchanges benefit from higher economic growth because more companies are likely to go public there and more investors will want to invest in those markets. And banks, the biggest part of financials, benefit from both. Faster growth means they can lend more, and higher rates means they can make more money when they do. The third reason I think European financials could have more room to run, which I would say is like the icing on the cake, is that while regulation was tightening a lot post 2008, increasing the cost on banks, now there are signs that it could be moving the other direction. So, do I expect European banks or the Mag 7 to nearly triple again over the next 3 years? Definitely not. But I do think the setup is better for European banks than the Mag 7. And even if you disagree with me and want to keep lots of exposure to US growth stocks, that's okay. I think European banks offer a really nice complement to those kinds of investments. Let's think about what drives each one. The keys to success for the Mag 7 and other growth stocks are AI progressing at a faster pace than is currently expected, and the same companies who are leading now remaining the leaders in the future. Whether those things happen or not, it has almost no bearing on European banks. What would cause these stocks to not do well? Well, the opposite, if AI is a bust, which also would have almost no impact on European banks. If anything, it might cause people to reinvest more in non-US companies, which would boost their valuations and weaken the dollar, all else equal. So it might even be positive for European financials. What are the things that would help European financials keep the party going? Some combination of European rates staying high, European growth being better than expected, European banking regulations easing, and/or the dollar continuing to weaken. None of those things would have much, if any, impact on the Mag 7, the ticker of the ETF I use to represent European financials, and the most direct way I can find to invest in them, was EUFN, the iShares MSCI Europe Financials ETF. The most direct way to invest in the Mag 7 that I'm aware of is MAGS, the Roundhill Magnificent 7 ETF, which comes at a 29 basis point expense ratio and invests in an equal weighted combination of the Mag 7 stocks. If you found this video helpful, please do us a solid by leaving us a like on your way out and hit that subscribe button. It really helps out the channel and it might just help you out too. Thank you for watching, and we'll look forward to seeing you in the next one.